Hey guys, Joel Frank here, market analyst for YouTrading, and this is the mid-week market update, so let's jump straight into it. Starting by looking at the S&P 500 as our, good proxy for what US equities have been doing. You can see I've got it on 4-hour candlesticks, and we started the week up here around 4,350, and we have dropped since then, although it has kind of been all over the place trade really, with the S&P 500 largely sticking within recent ranges, as you can see, because I've got it marked up here. The top of the range is 4,370, the bottom of the range is 4,270, so it's like a 100-point range that we're moving between. And it actually, to me, looks as though we're starting to see the price squeeze a little bit into a pennant formation. You can see right now we've bounced off. There's been 3 touches on this bottom support, each of them a little bit higher, these lows, and we've bounced off of that. So at the moment, technically speaking, everything going pretty well. But yeah, so broadly speaking, equity is still lower on the week. Why is that the case? Well, the main thing this week has been concerns about inflation. Now, what's been driving those inflation fears? Number one, natural gas prices have been skyrocketing in mainly Europe, but also in Asia and the US. There's just, simply put, there's a shortage of natural gas this year, and we're heading into winter, so it could get worse. And obviously, natural gas prices going up, that drags other energy prices up with it, and energy obviously is a key component of inflation, and it's a key. It's typically one of the most volatile components of inflation. So yeah, that's been pushing expectations higher. But we've also had a lot of evidence in various forms, be it business surveys or earnings or observing real-world events, all pointing towards a worsening of supply chain disruptions. I mean, this has been a theme that's been going for a couple of weeks now, and continues. So this week we have seen market-based measures of inflation expectations in the UK, in Europe, moving to multi-year highs. I believe actually inflation expectations in the UK at their highest since 1980. In the US, they're also moving higher, but not at their highest for the year yet, but not far off. Inflation expectations rising, coupled with the sort of thought that growth is not doing too badly, but has peaked, and central banks in the US, in the UK, in a lot of other global markets, developed markets, are going to be moving towards tightening. All of that combined isn't really the best combination for equities, which is why it seems when you look at equities on like a broader horizon, it seems that the bias is towards the downside. But just in the medium term, we've got NFP coming up at the end of the week, which could cause a bit of choppiness. And technically speaking, obviously, if you break to the north of this pennant, well, then you'd be targeting the 21 DMA here at 4,400, well, just above 4,400, and then the 50 DMA here at around 4,440. Those would be your immediate targets. To the downside, you've obviously got the low from the end of last week at 4,270-ish, and then this low here from the 19th of July. But once you break them, you've got the 200 DMA. Wow, we haven't been to the 200 DMA in a while. Who knows? If we go back there, that might be seen by some as a good dip buying opportunity, but the dip buying strategy has kind of failed in the last couple of weeks. I mean, it was such a good strategy for such a long time, but yeah, since these inflation fears and central bank tightenings getting closer and all of that, the dip buying mentality has taken a bit of a beating. But anyway, looking at other asset classes, this is the US 10-year bond. This is its price as opposed to its yield. Remember, price and yield move inversely. So what we've seen is prices moving lower, yields moving higher, pretty much ever since the September 22nd FOMC meeting. Partially being driven by the fact that that meeting was more hawkish than expected, and hawkish central banks do reduce bond values because you expect them to hike interest rates, but also because of the inflation expectations that I've been talking about rising, because obviously when inflation goes up, or expectations for inflation go up, the real value of the future payments that you're going to get on these bonds, be it the coupons or the principal at the end of the bond's life, that's eroded, which is why the price goes down. So yeah, if that continues, looks like we're going to test some of these lows here from June, and then potentially all of these levels of support might just go like dominoes, really. You've then got this one in May around 155, and then this one from the 18th of March, which is the low of the year. So yeah, the bond bears, those will be their targets to the downside. And then to the upside, resistance, you've got all these 200-day DMA there, 161, then just above it, 21 DMA, 162, and then the 50-day moving average just above 163. So quite a lot of resistance. Moving on to crude, we've been talking about inflation expectations rising because of energy prices rising. Well, here's a good example of those energy price rises. Crude oil has been pressing higher. When it hit this high this morning, just shy of the $80 per barrel mark, that was its highest, I believe, since 2014. We'd have to scroll way back in the chart. But a bit of profit taking for now, and it looks like we're going to come back and test these previous highs, which probably will offer decent support. I mean, we'll have to see. Things are so choppy. This could be chopped through. I mean, there might be a lot of stops there. So just be careful. Finally, the US dollar. As I've been saying, for equity markets at least, it's been choppy, mostly risk off this week. And that favours the dollar, which is a safe haven currency, which is why the dollar has been able to sort of pick up. Well, it started the week probing these lows underneath the 94 level and was stuck around 94 for a while, but then it respected this uptrend that's kind of been in place since mid-September, and it has rebounded back towards the high that it set at the end of September, around 94.50. Didn't quite manage to test it in recent trade, but you know, it is looking like things are going that way. And remember, if bond yields continue to rise more in the US than they do elsewhere, well, then that will probably continue to support the US dollar, because then dollar-denominated bonds, which there's a huge market for, will become more attractive relative to the bonds elsewhere. So you'll see flows coming into the US, which will support the dollar. Another thing is, we've also had the US data that we've had out this week so far, ISM Services PMI, and we just had ADP's estimate of national employment change, both for September, both better than expected. So perhaps a bit of optimism, maybe not global optimism, but a little bit of optimism that, okay, US economy is doing a bit better than expected. Maybe not that's not the case elsewhere, so maybe let's buy dollars based on that divergence. But that is going to be put to the test at the end of the week, because we do have NFP. Although this NFP is probably not going to be as important as other NFPs have been, because most analysts, I think, and I kind of agree, think that the Fed's decision to announce its QE taper in November is pretty much a done deal now. I mean, obviously we don't know yet, but most people think even if this jobs report is bad, the Fed's going to just announce their QE taper, because most of the Fed's board, it seems, no longer thinks that QE is useful. To be honest, QE is useful for crisis fighting, for stopping a financial crisis, but the US isn't on the verge of a financial crisis right now, unless, imagine if they don't extend the debt ceiling, and then there's a default. Well, then that would be something different. That could throw everything into kilter. But anyway, guys, hope you enjoyed the video, and I'll see you all in the next one.